Very welcome to all of you. I'm very happy that you made the way here and that you didn't get stuck in the traffic. I want to also welcome you on behalf of the entire management team of DT, the most wonderful management team you can imagine. They're all over there. And maybe you will briefly stand up and bow to your owners and say hello. That's my team. We hope you find these upcoming 1.5 days most informative and useful. I can tell you we've put a lot of work into preparing for this. Sometimes I felt there was, no bigger purpose in life than to prepare for this day, but I sometimes also get reminded that there are customers out there. So we hope you find it useful and you take away key messages and like the story, and thereafter hopefully buy our shares. Without much preparation and without much ado, I would like to go straight into the key messages. And I want to open my presentation with key points, 5 of them. Number 1, if we look at the 2010 to 2012 period, we have achieved against most of our objectives against the industry trend. And we will show you where and to what extent. Second, we are going to make significant additional investments into the German and into the United States market. For good reasons, because we see new opportunities. Third, we finally have reached an agreement with Apple, and we will launch Apple products in the United States in 2013. Fourth, overall, we see a chance to return to modest growth in 2014, driven by revenue stabilization in Germany, driven by a return to underlying growth in Europe in 2014, and driven by a return to growth in the United States. And fifth, as a result of significant investments and as a result of the introduction of the Apple products in 2013, this will lead to a lower free cash flow. And the dividend also will be lowered to a prudent and sustainable level. And as we delivered over the last 3 years against our promises, we intend to do so over the next 2 years, and we will give you guidance for the dividend for the next 2 years. The first part is what happened between 2010 and 2012. Back in 2010, if you recall the Investor Day, and I think it was in February, if I'm not mistaken, or in March, we gave you a 3-year plan strategically and financially as to what we wanted to achieve. Overall, the strategy implementation, which we presented to you in 2010, is well on track. On top of that, the financial strategy and a 3-year dividend plan has been executed, or we intend for the 3rd year, 2012, to continue to execute with our dividend for 2012 to be paid in 2013. A couple of key achievements over the last 3 years, just to recap briefly what happened, what we promised, and what we delivered. 4 blocks: fix, transform, and innovate, plus how did we address the investor side. On the fix part, if you recall what happened, we had to fix our situation in the UK. It was very difficult. We had to do something about the US market, and we had to work hard to keep our broadband market share in Germany and to improve our profitability. Plus, we fixed the situation, the ownership situation in Poland. I will talk about the US in more detail, just briefly addressing the UK. The asset developed into 50% of an outperforming market leader on track for further value generation. Strong contract growth and reduced contract churn. Mobile service revenues, ex-regulation, are growing. LTE rollout plan ahead of competition. 33% pop coverage already in 2012, and well beyond 90% in 2014. So that's a very, very good story in the UK. I think it's fair to say we fixed a big problem and turned it into a big opportunity. Poland, we had a 10-year ownership dispute. We solved it. Ownership 100% secured. Rebranding to T-Mobile, successfully executed in 2011. Good story. Germany, personally, I find the German team does a very good job. We're defending ourselves against asymmetric regulation against a strong cable competition very well. And not only that, we also increased our profitability. We did a great job on efficiency, defended our market share mostly, and we improved our profitability margin by 4%. The most important market. On the transform side, the biggest cultural revolution for this company was the amalgamation of the mobile and the fixed business. Nobody thought this would get done. We did it, and we did it in the last 2.5, 3 years. One company was created in Germany and in 3 other major markets, and gradually we are seeing cross-selling benefits, one-stop shopping experiences for our customers, churn reduction, and so forth. And there is more to come. On the cost side, we promised a significant efficiency improvement. We over-delivered. We promised over 3 years 4.2 billion. We accomplished 4.5 within 2 years, 1 year ahead of plan. And the third big block, also a massive structural reform for DT. We put together all IT resources under one roof, and we established Telecom IT. Now, if you're familiar with the situation of most telcos, IT systems and legacy systems grew from the various parts of the organization, mobile and fixed, in different directions. A lot of redundant work and stuff going on. We put it all together, and the objective is not only to be better in delivery, but also to increase the efficiency significantly. The objective is to save 1 billion IT spend by 2015. On the innovation side, in Europe, we defined 4 corporate priorities: machine-to-machine, cloud, rich communication suite, and blackout, just a second, that happens, mobile payment. So these 4 things are group-wide innovation projects where we intend to roll them out across our footprint, leverage the scale effects, and become successful in those areas. The innovation priorities are defined. The growth areas are overall mostly on track, the biggest one being the mobile internet opportunity, in which we believe since many years, for which we have made significant investments already, and where we are the leader in quality, network performance, and also in the market overall in Germany. The partner program is also accelerating. We realize we cannot do everything ourselves, so we need to collaborate. We are a big electronic distribution engine for content and for services, and therefore our partnering program has increased, has got traction, and we've collected a number of internet partner companies which we cooperate with. Lookout, for instance, Box, which we recently introduced at our Cloud Day, or many others, smaller and bigger ones. And our objective is to increase the number of partners and to leverage our distribution, our technology platforms, and our marketing. On the investor side, we promised something which we delivered. We promised a dividend level of 70 cents over 3 years, and we delivered against that. The first 3-year shareholder remuneration and dividend commitment, which we introduced back in 2010. We introduced ROCE as a steering mechanism for the group. We didn't accomplish all of what we had intended, but we introduced ROCE as a steering mechanism, and we continue to do so. I think it's fair to say we had strict M&A discipline and very good execution over the last 3 years. And I will come to some of those deals in a minute. As a result, we accomplished a good relative total shareholder return, and our valuation performance relative to our peers has been also beyond average. In more detail, the US situation. What happened over the last 12 months? 5 big steps. We were very busy. 1, after the AT&T deal broke up, we received spectrum in a number of important markets. We received 3 billion in cash as breakup. And the second step was we made use of, we invested into network modernization, a significant program. 37,000 sites will be modernized in 2012 and 2013. Spectrum reallocation has largely happened already. And we are upgrading our sites in the next 12 months. Verizon spectrum, we accomplished more spectrum. We achieved more spectrum through a deal with Verizon, which enables us to build a more efficient network and to have a better LTE coverage. Then, most recently, we announced the tower transaction. 2.5 billion proceeds from that very transaction, which gives us the chance to maintain our operational flexibility and makes us more cash rich. On the last block, the biggest one, Metro PCS, we announced it in October. It creates the leading value carrier in the United States. It delivers an NPV of synergies between $6 and $7 billion, and it gives us an improved spectrum position. In many markets, 2 times 20 megahertz for LTE. That is significant. That makes us one of the leading carriers in this regard in the US. However, these are all steps in the right direction, but we are also aware of the market reality, and we think that over the next years, the market will need more consolidation. Through this combined entity, through this reverse merger into Metro PCS, we will be a listed company, and it'll give us more flexibility to participate in further consolidation moves. And we think these consolidation moves will be necessary, given the need of scale, the spectrum reality in the market, and other circumstances. So this is something we are aware of, and we believe this will happen, and we are open, and we would not rule out any further moves. This is the summary of the KPIs which we introduced to you, or which we told you we would strive for back in 2010. Some of them we have reached fully, some of them we have reached partially, and some of them we have not accomplished. First, what happened on the group internet-based TV services? We are serving about 5 million customers by now. The difference to 5.5 mostly comes out of Germany. We are still growing, and we are growing in Germany with internet TV, but not yet to the rate which we had targeted. So we're at about 5, but still growing, and therefore we consider that picture is yellow. The group-wide mobile customers here, we wanted to get to 140 million. We deactivated over the last 1.5 years quite a number of inactive prepaid SIMs, and this number excludes the number which we have accomplished, 132 million or so, excludes the UK. So overall, yellow on track. Group-wide fixed broadband retail, done. 17.5 so far, and on top there is wholesale customers in fixed line. Revenues, more than 6 billion mobile internet revenues, 6.4 this year, that's the forecast. So we are well on track to accomplish our 5-year objective to get it up to 10 billion. However, we did not yet stabilize the German revenue. We still have a small decline in Germany. It's the trend in Europe, and if we compare ourselves to our peer group, we're doing very well, but not yet fully stabilized our revenues in Germany. Our Save for Service program over the last 3 years, well on track, better than expected, 1.8 billion net savings just in Germany and SEE markets. So 4.2 overall, 1.8 net savings just in Germany and other European markets. Free cash flow, our objective was to slightly increase the 2010 level. That has not fully happened, only in 1 year, but grosso modo we maintained it at around 6 billion. So overall, strong free cash flow performance. ROCE, our very ambitious objective, not accomplished. If we exclude the latest depreciation for the US, we would have only accomplished 0.5% or 50 basis points. That's not good enough. We keep it on the agenda for the next years. We have, again, set ourselves ROCE objectives, and Tim will talk about that in more detail. Shareholder remuneration, 70 cents dividends paid in 2 years, and the 3rd year we will recommend the same thing to our supervisory board and then to the AGM. So far delivered, but the share buyback program was only delivered 1/3 out of 3 tranches. The reason is simple. We believe the money will be wisely spent and invested as opposed to now being used for share buybacks. And we believe that the second and third tranche would be invested into Germany and the US will get better returns over time. What happened as a result? Over the last 3 years, our shareholder returns are beyond average. Worse than Vodafone, but better than the other peer group. With a TSR since 2010 of 13.5% and a relative improved valuation to 4.7 times EBITDA and a fairly stable 5-year CDS spread and rating stable, we compare ourselves favorably to most of our peers. So that was the result of a stakeholder-oriented approach, and I can already say we intend to continue a stakeholder-oriented approach and also look at the shareholder side, but also at the debt side. Markets and trends. What's the industry situation and how are we going about it in detail? The picture remains mixed. We have pressures, particularly coming from the economy. We do not think the European situation is resolved. We think Europe will continue to be under much economic pressure for the next couple of years. We are realistic about it. But we see the US recovering. And so our portfolio in Germany and the US is most important to us because Germany within Europe is a very strong market. Overall, the market remains under price pressure, particularly in the traditional part of the business, but there are also new growth opportunities by the IP transformation. In particular, quality of service management, which will allow us for tiered pricing models, which will allow us for new business models, virtual PBX solutions, rich communication suite based on IP, here we call it Join, and more efficient networks, where we do run very aggressive IP transformation or all IP transformation programs, particularly in Eastern Europe, in Macedonia and Croatia as test markets. Changing regulation, probably the most important topic to talk about tonight and tomorrow, because that does trigger a new approach to investing into our key market in Germany and potentially in other European markets as a consequence. Very, very important. And growth markets, in particular mobile internet, intelligent networks, cloud-based services, and so forth. I will only focus, instead of going through all these things, I will focus on 2 blocks. 1, the regulatory environment, and B, the growth markets. Neelie Kroes, in July, the commissioner, has made a revolutionary speech and announcement. She has said that she will want to change the regulatory framework in Europe because she and her team understands, and we had many conversations. They understand that investment-friendly regulation will eventually lead to needed investments in our infrastructure. They also see Europe falling behind, and they understand the reasons, and the reasons clearly are in regulation. She announced a regulatory framework to be stable until 2020. That's a revolution. 8-year planning horizon for the first time. Second, she said the profit pool, the existing profit pool, the unbundled local loop should remain stable. No more price pressure on the unbundled local loop. So we have a more stable revenue source to generate enough cash to make these long-term investments with. Third, she said, no cost regulation for optical fiber networks, for the next generation access networks, provided that there is, and I think we can all say there is, it's demonstrable, sufficient competition and non-discrimination practices in the market, which goes without saying. And fourth, next generation networks would include VDSL, fiber to the curb, plus vectoring. And this would also be supported by the European Union. They call it VULA, Virtual Unbundled Local Access, which is nothing but, we call it bitstream access. It's the virtual product for our competitors, and it replaces the traditional unbundled local loop from the street cabinet to the household. So as opposed to sub-local loop unbundling, we would provide VULA, Virtual Unbundled Local Access, which we're happy to do on the basis of commercial negotiations with our potential customer competitors. The most important point is that this regulatory framework, which I think is revolutionary, which I think is right, where Neelie Kroes really understood what this market needs, that this gets translated into national regulation as soon as possible. This is the precondition for us making additional investments into this market. And this should happen, hopefully, in the next couple of months in Germany and other European markets. It's our basis for our investment plan. If you look at the total market, you see the projections here straightforward. Traditional telecommunications in fixed and in wireless, including text messaging. Now imagine this, a few years ago everybody was texting, now we call it traditional communication. This market moves fast, is going down. And we need to be realistic, is going down by 3%. Mobile internet in our markets, including the US, is going up from 43 to about 84 billion in our addressable markets. By far, the US is the biggest chunk of that growth. Connected home, primarily content services, but also additional services, security, and whatever you name falls under that category. Triple play and more is growing slightly by 3%. On the ICT side, where T-Systems is a cloud pioneer since years, and T-Systems is continuing to build its cloud capabilities, but we are also active in selling to the small and mid-sized companies. On the ICT side, the cloud is the most important part. Cloud services and virtualized IT grow from what it is today, about 80 billion globally, to about 158 billion in those markets where we are represented. Whilst conventional ICT services are growing mildly only by 2%. So that's kind of the cosmos of the opportunities we're working in. Our objectives for the next years are pretty much what they used to be a few years ago. We have some changes, but overall, we pursue this grid of numbers consequently. We said a few years ago to you, we're striving for 10 billion revenues in mobile internet. And here I stand today and I say, we will achieve that number, we might even overachieve that number. The trajectory looks very good, and to me, we've only scratched the surface of wireless internet services. The cars get connected, cameras from Samsung now have a radio interface. You don't need much fantasy to imagine that the connectivity business in wireless internet is growing like that. It's like an S-curve, and the market has just taken off. Connected home, our objective is to get up to 7 billion. Online consumer services, for instance, the Scout business, which you may be familiar with, or Strato, or any other of our portfolio, or Portal business even, or multimedia services, etc. All small flowers, but they're growing nicely, and we intend to get it up to 2 billion roughly. T-Systems external goes up to 7, and the intelligent network services, in particular currently we are successful in the health sector. That altogether will go up to between 800 million and 1 billion. So we're more or less in line with what we said a few years ago. Our revenue mix as a result of that is forecast to become more towards these new growth areas. The revenue mix changes from what it was 24% in 2010 to then up to 45% in 2015, coming out of these new areas of growth. How do we go about it? It doesn't happen by itself. First of all, these are the objectives per segment. We are forecasting to stabilize our revenues in Germany in 2014. We will compete aggressively against not only the wireless players, but also the fixed line players. We are not leaving the turf to them. So far in Germany, we've defended ourselves excellent. However, the challenges will grow, and we need to do something about our network performance in order to remain competitive. Europe, we're returning to underlying growth. There's a lot of headwind in Europe. Economy, state budgets, extra taxes, and so forth. And yet, stripping these effects off, we believe we can return to underlying growth in 2014. Reinvigorate growth in the US based on network modernization, based on an aggressive marketing, a clear position on the value side, new distribution channels, B2B approach, and the cooperation with Apple. We believe we can get back to growth. And you will hear John later on. I think our morale has increased after the AT&T deal. We are on the right track now to get back to growth. On the digital business unit where all the new activities, the small plants are accumulated. We can generate double-digit growth, albeit on a low start level. And on the T-System side, our objectives are the market unit, the external business, profitable growth, improve profitability, decrease our cost structure, because in some cases we're too expensive currently, particularly in systems integration. And on the internal side, telecom IT side, our objective is to deliver quality, defined quality at lower spend. Very important part of our efficiency program. How do we go about that? Very simple. We will compete aggressively, we will innovate with passion, and we will transform with rigor. Compete, transform, and innovate. That's the 3 building blocks. And we have 4 key blocks where we go. Seamless connectivity, which means we combine fixed and mobile technologies so our customers are always best connected. When you as a customer are with T-Mobile or with Telekom here in Germany, you can use our hotspots, and we'll increase the number up to 18,000 in the next couple of years, and you do that seamlessly. You can use the best LTE and HSPA network, and you can use the best connectivity service also on the fixed line side. Seamless connectivity for the gigabit people, gigabit society. More innovation, not only by ourselves with more agile methods, but also by cooperation with third parties, secure cloud solutions, and best-in-class customer experience. That is one of the most important differentiators. As of today, in Germany, everybody now says Telekom are the best in customer service. A few years ago, none of you, none of our customers, none of the media would have ever thought that would be possible. Everybody was, pardon, criticizing us because of bad customer service. Now, everybody says our service is better. We are winning every test, every Stiftung Warentest, every TÜV report, everything. And that is very important to us because we cannot differentiate ourselves by being the cheapest. We have to differentiate ourselves by being the best experience. And we will not rest up until our lead is that big. And therefore, Germany is continuing with very consequent customer experience programs, eliminating the glitches and the problems which we still have, because not always everything goes well. Europe is doing the same thing. We work on the network modernization program in the US, as I said before, Apple partnership, integrated network strategy for Germany. These are the compete elements. The transform elements, all IP transformation, continued efficiency program. Our target is 2 billion or more. So far, we only identified measures up to 1.6. We'll go beyond that. However, our track record in efficiency, I think, is credible. We've done a great job in the last couple of years in improving efficiency. We always over-delivered. Here is so far our target, and we don't want to overpromise and under-deliver, and therefore we'll go for that again. On the innovation side, I said it all before, intelligent networks and cloud and corporate innovation priorities. Compete, transform, and innovate. This is the way how we go about it in the next couple of years. The German strategy is very simple. Full steam ahead on LTE. We are exclusive currently with this device on LTE in 1800 because we were aggressive in the auction on 1800 2 years ago. And we have rolled out an 1800 network in major German cities, Cologne and other cities. And therefore, currently the iPhone on LTE 1800 works on our network exclusively. You cannot get it elsewhere. And that advantage hopefully remains for a while. Now, number one, LTE rollout, boom, full-fledged. Fiber rollout, fiber to the curb, again, based on this change in regulation, we will go for that. And we go up to 65% coverage in the next couple of years, with an option to go even beyond that. But that does require some public co-funding, because going beyond 60% or 65% is going to be quite expensive, and we hope to find, from the Connecting Europe facility to local cooperation with municipalities and regions, or even the state, some co-funding programs. They are needed. On top of the FTTC program, we'll introduce vectoring. Vectoring gives us 100 megabit download. Okay, that's competitive. More importantly, vectoring gives us 4 times better upload. Vectoring gives us up to 40 megabit of upload. Why is that important? Cloud. The more people and the more companies and the more small companies go into the cloud, and they will, the more needed is the upload speed. Cable cannot compete. Cable can compete on the download. Cable cannot compete on the upload. Cable cannot compete on customer service. Cable cannot compete in combination, of the tariffs and the service bundles with wireless. So we will work on competitive differentiation against cable. And lastly, we are working on something we call hybrid access. Hybrid access means that devices based on software can combine the wireless and the wireline/Wi-Fi speed. That is possible. But on the long run, we'd like to see routers to combine the two and then provide an even better experience for our customers. Then you combine the characteristics of a wireless network, the speed, but peak speed, with the capacity of a fixed line network. So, we're working on this. The introduction date is not yet clear, but we have it, as one of our key objectives for the next 2 to 3 years. So that's our strategy for Germany. With that integrated network strategy, we will compete against cable successfully. US, and John is much more qualified to talk about. He's only here since 2 months. It feels like he's here since 2 years. He's already deep in all matters. We are going for a quick rollout of LTE. First half in 2013 will cover up to 100 million POPs. The other half in 2013 will cover up to 200 million POPs. And more importantly, through the spectrum refarming, we're also increasing the availability of HSPA based on the PCS spectrum, and that goes up to 200 million POPs by the end of 2013. Now, again, we've entered with Apple in a relationship. I cannot go into more details, I'm afraid. So you'll have to stick to, you have to make your own assumptions, but the numbers in our free cash flow projections, the Apple introduction is fully baked in. And the only thing I can say is I'm glad we finally gotten an agreement. I'm glad we're going as fast as we can together with Apple to bring products to the market and offer a great customer experience, not a limited one, a great customer experience with our combined network. And our US team is working very hard to bring the network performance to a superior level, including LTE. And the financial guidance incorporates all those elements. What's the outlook? 2 things. One is Germany, and the other one is the US. That's the focus. Everything else is more details. Today, we're doing 8.3 billion of investments. Next year, we'll raise that up to 9.8. The biggest chunk next year is in the US. It's largely impacted also by the PCS integration, the CapEx, and by the network modernization. The year after, the US CapEx normalizes to about 3 billion, but then the German CapEx goes up. In 2013, going into the INS strategy, Intelligent Network Strategy for Germany, Integrated Network Strategy, means we are preparing, but there is quite a lead time. So the peak CapEx is coming in the years thereafter. But the US next year will peak in its CapEx. As a result, higher CapEx of 9.8 leads to lower cash flow of about 5 next year. And then in 2015, we still are on a high CapEx level because of the German program, but our free cash flow is expected to be again on the level like this year, at 6, roughly. So, how does it look like in a financial summary? We're addressing the equity side, we're addressing the debt side, and we're addressing the value creation side by running the business in the right way. On the equity side, the dividends are forecast to be 50 cents for 2013 and 2014. And in 2015, we will revisit them because we believe we have a very good case for 2015 again. Yeah? So the free cash flow will be lower for 1 or 2 years, but then in 2015, it'll definitely go up significantly. The alternative, by the way, is very attractive, is a dividend in kind. So that's the shareholder side. On the debt side, we continue to work on having undisputed access to debt capital markets. Even though the rating agencies have moved their, their criteria recently, we reflect that by saying our rating band is between A- and BBB. That gives us undisputed access to the debt capital market at decent rates. Our net debt to adjusted EBITDA is forecast to be between 2 and 2.5. The equity ratio between 25 and 35%, and liquidity reserves were covering maturities of the coming 24 months. Value creation, efficiency management remains an important element of our strategy going forward, because we have to have flexibility also, when economy turns bad, or so we need to have resilience, and therefore we work very hard on the cost side, continue to work on this by about 2 billion, as I said, and we try to increase the ROCE to 5.5%. Again, another attempt. Now, you may be skeptical, but we are committed to do this. Portfolio management, no big M&A, at least not, no big M&A, not outside footprint, remain disciplined. Strategic review of Scout and Everything Everywhere. That's also an important message. We see what we do best to create value. And Scout performance has been great over the last years. Now we look at ways to maintain that great growth level, and therefore we look into these two assets and review the options. Risk management. If you think about it, in our sum of the parts, 85% of our portfolio are in low-risk countries from a value point of view. 85%. And that's, I think, fairly good in these days. So that's the picture from a financial summary as I can explain it. Tim is much more precise and detailed, and he will give you more details tomorrow, as my colleagues will on the other topics. I just want to leave you with our guidance, and that looks for next year between 17.4 and 18.4 billion, including PCS. It looks about 5 billion free cash flow excluding or including Metro PCS, doesn't change much. The dividend per share is about 50 cents, including or excluding PCS, same thing. The midterm ambition goes beyond that. We believe we can grow again in 2014. We also can grow again the adjusted EBITDA in 2014. We can provide a group free cash flow in 2015 of 6 billion. We can improve the adjusted EPS to 0.8 euro, to the ROCE to 5.5%, and we will review the shareholder remuneration policy in 2015. And we only have visibility for 2 years, but we believe there is a great opportunity, if we do the right thing now, to stop the trend, to swim against the current a little bit because the regulation changes, and to get back to new growth if we do the right things, and we need to invest something now in order to get there. So I hope you can understand the logic. I hope you find it appealing. But I think the most important game changer for next year is the US. And therefore, I brought somebody who is really only a few weeks with the company and already very deep in all those matters. And I think I can seamlessly hand over to Stefan Eger. It's not him. All right, thank you very much.